Well, okay, thank you all. It's around noon, so we can go ahead and get started here. Just wanted to say, again, a big thank you for you all to joining us. I know a lot of the names that have logged in, but if we haven't met before, my name is Vanessa McElrath, and I'm a wealth advisor and partner here in our wealth management group. And I also have with me Julie Reinhardt, which I think all of you know, and you're well aware, she's the jack of all trades with anything retirement plan related. So glad to have her on here as well. And we certainly wish we could be here, be together in person, but I think we've all probably done enough of these now where we've learned to adapt given the situation. But before we get started, just a couple of house cleaning items. We do have some time reserved at the end for Q&A, but if there's any questions that you really need clarification on or you want to ask throughout, you can use the Q&A button. So on your toolbar, you can hover over that Q&A and then submit questions there. So feel free to use that, and we'll do our best to monitor that as closely as possible so we can get those questions addressed while we're all together. But other than that, we can go ahead and just dive in. And I know, a lot of you, you're here today, you wear a lot of different hats and play a variety of different roles within your respective companies and firms. And just one of those roles that you play is as plan administrator and fiduciary. And, that's a lot under normal circumstances, and then just throw a pandemic on top of everything. And I know you guys have more than enough on your plate. There's just been a whole lot to digest this year. And because of that, that prompted us to put this session together before the year end. For starters, I think it's really important to understand the regulatory changes that have come down the pike. And some of that will definitely impact kind of what you need to know for this year. And so today, again, we're going to cover some of those regulatory changes. And some of those stemmed from the Secure Act, which actually was passed at the end of last year. So that was all pre-COVID. And then, of course, the CARES Act. That was the stimulus, that coronavirus relief package that came about and had some implications for retirement plans. And so Julie's specifically going to dive into that. And then she'll also talk about how that might impact the upcoming document restatement cycle for qualified plans. And then always, if you know us, it's always good measure to review fiduciary best practices. Just because there's a pandemic and we're all navigating different challenges and working from home, we can't and don't want to skirt or neglect our fiduciary responsibilities. So we'll kind of review some of those top reminders. And then we also included a little bit of information on cybersecurity. Obviously, a lot of our workforce and employees and participants are working from home, and fraudsters and hackers are really trying to take advantage of that. So what are some online safety reminders that you all should know and that we can also encourage our employees and participants to know as well, just so that they can be additionally safeguarded, because they are getting very sophisticated. And so with that, we can dive into the regulatory updates, and I will turn it over to Ms. Julie.
Well, thank you all for joining us. Just want to echo everything that Vanessa said. We're really glad you could make it and join us. And again, we wish we could be together in person, but as she said, we're all definitely used to this by now. So in 2019 and 2020, they're full of all kinds of changes for retirement plans. We're going to address the Secures and the CARE Acts in our first few slides. One of the notable changes that we wanted to mention with the Secure Act is just the age in which an individual is required to start taking required minimum distributions, or RMDs. The previous law said that an individual had to start taking, in most cases, by April 1st after they turned 70 and a half. They've upped that age now to 72, and so it allows you to wait a little longer before you have to start paying those taxes back on your retirement plan. But the new rule only affects those people who turned 70 and a half in 2020 or later. Then that's going to up that age again to 72. If you'd already reached 70 and a half by the end of 2019, that doesn't affect you. You fall under the old age. Another change is the elimination of stretch provision for non-spousal beneficiaries of IRAs and other retirement accounts. They used to allow them to stretch taking those distributions out, and that allowed you to spread that tax liability over a longer period of time. So with the new law that anybody that passes away in 2020 or later, the beneficiaries will have to distribute that amount over a shorter period of time. There are some exceptions that still can stretch that out, but some people are going to be affected by that. And it just condenses that time period in which that distribution becomes taxable to you. The change doesn't affect, spousal beneficiaries, and there's a limited list of other people it doesn't affect. And both of those changes on this slide affect IRAs as well. So moving on to the next topic under the Secure Act, if there's anybody out there that there we go. If there's anybody out here who's not yet a plan sponsor and maybe is considering starting a plan, there's a new tax credit, above the line tax credit, that allows you to maximize your benefit by starting a retirement plan. And you can deduct 50% of the startup cost, administrative cost, education cost. There's a cap on that credit of either $5,000 or $250 times the number of NHCEs, or non-highly compensated people who are in your plan. Non-highly compensated people generally are people who have little to no ownership and make less than $130,000 a year. Another new credit is a $500 credit to go back one more, there you go. Another new credit is a $500 for adding automatic enrollment to your plan. And this also applies to existing plans as well. So if you added this feature, you could get that $500 credit. Automatic enrollment is just, it's a provision in your plan that participants actually have to opt out instead of opting in to defer from their paychecks. So you could set a predetermined level like 3% or 5% and require that people actually go in and make a different election than that. And if they don't, then that's what you withhold from their paycheck. So this might be a good time to consider adding that. Moving on to safe harbor plans. Safe harbor plans generally have to send out a certain kind of notice at the end of every year that tells what they're going to do for the next year. And for plans that are making non-elective contributions, that notice is now optional. For ML&R clients, under our current document, it's a little more advantageous right now to keep sending that notice. The way the document's structured, it'll allow you to suspend those contributions if you needed to, as long as you've sent that notice. It has some special language in that notice. And as we begin to move to new documents in 2021 and the years beyond, we're going to keep reevaluating and see if we still need to keep sending that notice. The Secure Act also allows for plan sponsors to decide, even after the beginning of the year or even after the year has finished, to make one of those non-elective kind of safe harbor contributions. Keep in mind, though, if you do decide after the year is over that you wanted to be safe harbor for the year before, then you do have a higher level of contribution that you'd have to put in. But it could be of interest for us to look at in the years to come. And then the last item on this slide, as of towards the end of 2021, participant statements are going to need to be revised to include estimated retirement income. And I know that our record keeper providers that we work with are going to be actively working on getting that updated, the software providers, into those statements for later on in 2021. Looking at the next slide, another optional provision that the Secure Act brought us is a different type of distribution called a qualified birth or adoption distribution. And again, totally optional. This distribution would be limited to $5,000, and it's exempt from that 10% early withdrawal penalty. Participants also would have the option to repay that distribution, effectively making it like a loan. And this also applies to IRAs as well. The last mention that we're going to want to bring up for the Secure Act is with regards to part-time employees. If you have immediate eligibility or a short wait period, it probably won't affect your plan very much. But starting in January of 2021, if you have employees that are normally working between 500 and 1,000 hours, they may not be eligible right now under your document, you might actually start having to allow them to defer in a few years. Let's say that your document requires that you have participants work for a year and they have to earn 1,000 hours in order to start participating. Well, under the new regulations, you might actually have to have them start participating. If an employee works between 500 and 1,000 hours and they're age 21 or over in 3 consecutive years, then you would have to allow them to start deferring after that year, after that 3rd year. And you wouldn't have to give them the employer contribution. So if you're making a match or a profit sharing, you may not have to give them that piece, but they would have to be allowed to start deferring from their paycheck so that they can save for retirement. If your vesting schedule depends on hours, and it's looking for 1,000 hours, you might have to add in an additional vesting credit for those employees in the event that they did become eligible for employer contributions at a future date. And since this isn't going into effect right now, there's still a little bit of gray area and some things that we're waiting on clarification on. This is going to start being in effect in the 2024 plan, or it should be. So we're hoping for more guidance from the IRS on how exactly this is going to work. And we know that our record keepers are going to be working on, updating their software to accommodate any kinds of differences that we may have to deal with in the future. And now we'll move on to the CARES Act. Go
Julie,
ahead.
quick question. We had a question come in, and it was related to the birth and adoption piece. Is that automatic for all plans, or does the employer have to adopt it?
That is a completely optional provision. You do not have to add it in if it's something that you want to add in. When we talk about the document restatement cycle, that's something we can definitely pull into that, but it is totally optional, not required.
Okay, great.
All right, moving on to the CARES Act. In March of 2020, the Congress enacted the CARES Act, and then they modified it a little bit in June for us as well, just to clarify a few things. There was a new type of distribution option, and again, kind of like that qualified birth and adoption distribution, this was a completely optional distribution that you could opt to have in your plan, called a coronavirus-related distribution, or a CRD. It's separate and distinct from other types of distributions. It's not a hardship, it's not an in-service, it's just a different type of distribution. In order to be able to take it, you had to be affected by COVID-19. So the participant would have to be diagnosed with it, have adverse financial consequences, be in quarantine, be furloughed, have a layoff, have reduced work hours, reduced pay. Maybe they got a job offer and it had to be delayed or had to be rescinded. But it also applied to if your spouse had that issue, or your dependent or somebody living in your household had that issue, then you could apply for that coronavirus related distribution. Right now, it's expected to expire at the end of 2020, but Congress could very well extend that into 2021. We haven't heard anything like that yet, but it could happen. The CRDs do qualify for special tax treatment, where you can spread that tax liability out over a 3-year period, or repay the distribution either back to this plan, to another plan, or to an IRA, making it, again, more like a loan and lowering that tax liability. But one nice thing is that even if you didn't adopt the special distribution, if a participant qualified for a distribution for some other reason, like maybe they did have a hardship, maybe they are 59 and a half and they can take an in-service withdrawal, or maybe they don't work for you anymore, but their spouse is affected by this, and they can it allows them to use that tax provision and spread that tax liability over the 3-year period if they fall into one of those categories already. Looking at the loan option, the CARES Act gave us some additional optional loan provisions. Again, these are all optional. We did have a higher loan limit, and that has expired. Taking those higher loans, it expired in September. Congress could revive it if they wanted to for 2021. Again, haven't heard anything about that yet. They could also defer loan repayments if you adopted that. So stop paying on their loan and it wouldn't go into a default, but those have to be reinstated as of right now in January of 2021. So they'd have to start repaying back. They could catch up by doubling up on loan payments. They could make a balloon payment if your loan provisions allowed for that. And then they could also extend that 5-year period out. This, again, optional for retirement plans. And the last thing that came about with the CARES Act was they actually suspended the participants to be required to take those required minimum distributions in 2020. So that allowed for our retired participants to decide if they needed it. If they didn't really need it, then that's, requiring that they pay taxes on that. And if they didn't need that, that might be an additional burden for them. And so that has been suspended for 2020. They can take it if they need it, don't have to take it if they don't. And now it is time for our first polling question. So if you are listening, we would like for you to join in. And did you adopt any of those CARES Act features? So we'll give you a few seconds to vote on that. If you adopted the distribution feature or the loan feature or both, please answer yes. If you didn't know, and if you're not sure, then answer unsure, of course. All right, it's looking like most plans didn't, and that has been my feeling as well from most of our clients. Didn't seem that they needed it, so they have opted not to take that at this time. All right, every few years, the IRS opens up a mandatory period for all of the retirement plan documents to be restated, and so that cycle is now open. Plans are not required to file for a determination letter any longer. The purpose of this restatement cycle is just to incorporate recent law changes, into the documents. In this case, our documents are going to be incorporating items from the Budget Act of 2018, and possibly, as of right now, we're not seeing those Secure Act and CARES Act provisions, and those are probably going to be a snap-on as those become, we get more guidance on those. So moving on to the next slide, the Bipartisan Budget Act of 2018 is where most of those changes were centering around hardship distributions. So if a participant took a hardship, which again is optional, not all plans have hardships, they had to take all of the any required loans that the plan offered. And retirement plans were required to stop withholding deferrals from their paycheck for a period of 6 months. So even if a participant was participating in the plan, they had to stop deferring for 6 months, and then you could restart them again. So starting in 2020, plans no longer had to take that loan first, and you don't have to suspend them for that 6-month period anymore. Additionally, anytime there's a federally declared disaster, that's automatically going to qualify for a hardship distribution. Again, only if your plan allows for hardships, but that's an automatic hardship reason. Casualty losses also do not have to be tied to a federal disaster. Under that Bipartisan Budget Act, you could actually opt in to start using those provisions in 2019, and I know a lot of our clients did. But in any case, if you're not a client of ours in our retirement plan department, you should have tracked those elections. Your provider should have tracked those elections, and those are going to need to be incorporated when you do your document restatement over the next couple of years. So moving on to the next slide, again, right now we're thinking that the CARES and the Secure Act are going to be snap-on amendments that will be made to these new documents, but it's critical that you make sure you know which one of those optional features you opt into. I'm hoping that your provider has sent you something where you have it in writing what you did, so that you know, when it comes time, especially if you move providers, that you have the documentation on which one of those that you brought into your plan and which ones that of those you opted out of. And lastly, for document restatements, we want to make sure, if you'll move on to the next slide, that when your document is restated.
Quick question, Julie.
Yes.
Another question that came in, just going back to the loan elimination, is that a mandatory change in 2020, or is it still optional?
The loan provision is an optional provision as far as I understand it, but the 6-month deferment is required. So I believe that is correct as I know it. All right. The last piece that talking about document restatements, it does give you the option to make changes to other parts of your document as well. So is there compensation that you might want to include or exclude that's different than what you're doing now? Or perhaps your committee or your owners have been discussing maybe changing when participants become eligible, what types of contributions you're making. Do you want to add a new loan or distribution option? Maybe automatic enrollment sounds more attractive to you since you're going to get a tax credit for 3 years. But start having those conversations internally and let your providers know what you would like to change, as you'll be getting, prompting from them, and make sure you've started having those conversations now. And lastly, before I turn this over to Vanessa, we have one last polling question. Is there anything that you already know that you might want to change or to add to your document? So looking at those. Hopefully that'll pop up here in a second. There we go. So do you have any optional changes you'd like to make? Yes, no, and I haven't thought about it until today. All right. And most people hadn't thought about it until today, but the other half of you don't have anything in mind. So start thinking, start talking, having those decisions amongst yourselves, especially when you're having your committee meetings over the next 6 months to a year.
All right. Moving on to fiduciary best practices. As I mentioned, it's always beneficial to revisit because it's so important. And one of, I think, the most basic steps is just even first identifying who is even considered a fiduciary, because that can help determine who needs to focus on these duties and roles and responsibilities. But basically, if you make decisions that impact your plan, then you're probably a fiduciary as defined by ERISA. And so another way to think about it is, there's a few different ways that you could actually become a fiduciary for your retirement plan. One is that, you're actually become a named fiduciary. So a named fiduciary is going to be someone who controls the plan operations, the administration, and even maybe the investment. So ERISA is actually going to require that every plan has one or more named fiduciaries, and you may be listed as an individual or part of a collective group or committee within the plan document. So those are what I would call a named fiduciary in the plan document. There's also, I would categorize as functional fiduciaries, and they're going to exercise discretionary control or authority or responsibility over the management of the plan, or control over the plan assets, or control over the administration. It could also be someone that provides investment advice for a fee. And then there's this third group, what I would call either accidental or unintended fiduciaries. And that's where you take an action that crosses a line into fiduciary status. So If you're not supposed to act as a fiduciary or not supposed to be a fiduciary, you need to understand what this is and is included in your role. But really, not everyone who interacts with the plan is going to be considered a fiduciary. And there's a variety of other different providers that we'll look at. So for example, you've got your record keeper, your third-party administrator, your custodian, and you could have some professional fiduciaries as well. Now you as a plan sponsor, as a fiduciary, it's your duty, one, to know your service providers, know who they are, make sure you can answer that question of who you're working with in all these different capacities, because it's your duty to monitor them and make sure that they are acting in the best interest of plan participants. So you need to know what the services they're providing, what their fees are, how are they charging their fees, and is it commensurate with the level of service that they are providing. And again, I think what a lot of folks find maybe a little bit surprising is actually the record keeper, the third-party administrator, and the custodian. They are generally not fiduciaries. So that's something really important to keep in mind. But there are professional fiduciaries that you can hire, and that's typically, you can hire an investment advisor to serve as a fiduciary, or a director trustee. But just make sure that that's actually acknowledged in writing, that they're actually acknowledging their fiduciary role in their contract. Now, you may serve in your capacity, and you may actually be the named fiduciary, but it doesn't necessarily mean that you're going to be responsible for all fiduciary duties, and you don't have to be. So as an example, the plan may actually permit you as a named fiduciary to delegate certain fiduciary duties to an expert, because in your role, you all play a very big part in running your organizations, whether it's as in an HR function or as a finance function, and that's really your core set of expertise. So it doesn't necessarily mean that you have to be or expected to be an expert when it comes to investments or retirement plan management. That's why you can bring in experts to help you with that. And so what a lot of folks may do is engage these experts and help with regard to the investment, so hiring an investment manager or some other fiduciary and administrative or directed trustee function. Now, that's going to help you fulfill and execute some of those fiduciary duties and responsibilities, but that doesn't mean that you're ever going to be able to fully delegate away any fiduciary responsibility. You're still always going to retain that oversight function. So even though you're going to appoint the trustee and investment managers, they may oversee the investing of the plan assets. But again, what your role and function is to monitor them and make sure that they're kind of doing what they had been charged with and set forth in doing. Now, there's a variety of different types of fiduciaries that you can engage, some related to the actual plan investments and some related to the administration. And with regard to investments, there's really two main types of fiduciaries that you can engage, and I would call it like level 1 and level 2. So basically a 321 investment advisor, that's the type of fiduciary you can engage. And what an investment advisor, a 321 investment advisor, what they do is they monitor and then they perform due diligence on the investments in the plan, and they make recommendations. And so those recommendations, they go to, let's say, an investment committee, and then the investment committee retains that final decision. They come to a consensus and they determine, okay, are they going to act, or how are they going to act upon these recommendations that the investment advisor makes. Now, you've seen I think that's where traditionally hired fiduciaries started, but more and more what we saw were these investment committees or named fiduciaries in the plan saying, hey, I'm hiring you for a reason. I'm not the expert, so I don't want to actually have to execute your recommendations. I actually want you to do that. And so that's what a 338 investment manager would do. They review the investment options, they do the due diligence, and they make the decision. So they take the ultimate responsibility for your plan's day-to-day investments. And so that's where, if you really want to delegate as much liability away related to the investments, 338 is going to become your highest level of fiduciary protection that you can engage. But again, it's just really important to make sure that regardless of you're working with a 321 or a 338, you want to make sure that they're acknowledging their status in writing. Back here. Another fiduciary that you can hire, and we've seen increasing popularity or a trend, I'll say a move in the industry towards this, is what's called a 316 fiduciary. So basically what you engage, a 316, it's a service provider, and they're hired to manage the day-to-day administrative work for the 401k plan. So for many of you, I'm sure you may find that the 401k administration, it's a lot to handle. You're filing paperwork with government agencies, you're providing and delivering the ongoing communication between the employees and the service providers. You kind of have to stay up to snuff on compliance. And working with the TPA. So this is a way where you can actually hire and engage a service provider to do all of that. So they'll sign the Form 5500, they'll approve and review distributions, loans, quadros, they're going to monitor contribution and timing, monitor the service providers, fixing errors, things like that. So to a certain extent, this is something that we've been helping our clients with. We do a lot of this review, and we may provide nudges and reminders on certain things with our clients. But what we saw and increasingly found was clients said, well, no, we actually want, is there a way where we can actually hire you to do it? And so as a result of that, we started offering the 316 services within the last year or so, because more and more there is a lot of administration, and there is a increased need for clients who actually want to hire someone to take care of this. So that is another type of fiduciary that you can delegate to on the administrative side of things. So with regard to fiduciary responsibilities, there's obviously a lot of specific duties to carry out. And even if you're planning to outsource or hire a fiduciary, you still have to monitor those service providers, as I alluded to earlier. And so as a result, what we see is many plan sponsors will actually establish a committee to assist in kind of fulfilling these duties and roles. So if this is a good way to think about it, and this is something that we help clients with, structuring a committee to kind of carry out all those responsibilities. And the first starting point you want to start with is really establish the purpose of the committee. What are they going to be charged with? And really their objective is to either make or assist the plan sponsor in making these decisions. So they may provide prudent oversight on plan expenses, plan investment strategies, and monitoring let's say the investment advisor that's hired, and making sure the plan is in compliance. So that's the first step. You want to really outline what their expectation is. And then second, determine who should actually serve on the committee. You could select specific people, or you could choose specific job titles if you want to make sure, for example, HR, finance, and legal are all represented on that committee. So, just keep in mind that you're picking the right folks, and that they understand that those folks themselves, they are going to be fiduciaries. So they really need to be clear on those responsibilities and what they need to do to fulfill those responsibilities. And so again, that's why we try to do these types of trainings periodically. So if you have new folks that join your committees, or you're setting a committee up, we can provide training on what's the expectation, how do you carry out these duties and functions, and how do you document these processes and procedures. And then, of course, once you have the committee up and running, you want to meet periodically and have somewhat of a regular or set schedule, and then keep meeting notes about the different types of issues that you're addressing, whether that's administrative or whether it's a more fiduciary related issue, such as regarding investments. And again, committees are something we can help with. We've helped a number of clients set up committees by establishing a committee charter, and that's something we can help map out the blueprint for. And it's just a great starting point to help really clarify, okay, who are the right people that need to be at the table making these types of decisions. Another really important fiduciary best practice is adopting and adhering an investment policy statement, or what's often referred to as an IPS. So an IPS is a document. It's actually not required, but it really is a best practice to have one. So if you look at ERISA law, there's never any explicit requirement of an IPS, but it's typically going to be one of those first documents that they're going to request as part of any DOL plan audit. So, thinking about what is this IPS and what does it include, it's basically a drafted policy statement that provides both the plan sponsors and the fiduciaries a roadmap of what's the investment philosophy going to be used, and what's the measurement and evaluation criteria going to be used for the investments of the plan. So it really kind of serves as your overarching philosophy of how to look at and evaluate the investment options, what's appropriate, what's not appropriate, and how are you going to ensure that those investments are in the best interest of plan participants. What's that process you're going to use? So that's really what's important about the investment philosophy and the IPS investment policy statement. And you always want to go back to it, because that's what's going to help drive how you continually evaluate and monitor the underlying investments within the plan. I will say it's a bit more art than science, because again, this document, you want it to serve as an overarching framework, but if it's too general or too short without any specific guidelines, it really doesn't do you a whole lot of good or help limit or provide any fiduciary protection to you. But if it's really long and complicated and convoluted, it's going to be really hard to follow, and it could actually be used against you, because if you have this really complex IPS but you're not following it, that could be considered a breach of fiduciary duty. So it really comes down to having a balanced, good process that you can actually follow in the day-to-day management and evaluation of the plan. And again, that's something that we help clients with. We have kind of a standard blueprint that we've drawn up for an IPS that we think is a really good foundation. Another really important aspect from your fiduciary responsibilities, and something that's really a best practice, is to continually benchmark your plan's fees and services. Because this is one of the core duties that you have as a fiduciary, is to make sure that the fees in the plan are reasonable, and that the service providers are providing service that's commensurate with the level of fees that they're charging. So you really want to take a good look, a good effort in trying to determine, okay, who are your service providers? What are they charging? How are they getting compensated? Is it an overt fee, or is there some sort of convoluted revenue sharing system where the fund is giving some of the revenue to the record keeper and some of the commission to the investment advisor, and could that potentially pose any conflict of interest? So you really want to have a clear picture and understanding of all of your service providers and how they're getting compensated. And then you want to look at, well, what's the value, what's the bang for your buck? Because cheapest doesn't always mean best. Again, you want to make sure that the level of service that they're providing is commensurate with the level with their fees that are being assessed. And a really important, or I think robust way to benchmark and look at the fees is compare it, see how it stacks up to other plans of similar size in terms of assets and number of participants. So you have some bit of comparison to see how your fees stack up. And again, it's something good to do at least, either annually or every other year to really understand, okay, how do our fees stack up relative to industry peers and benchmarks. And again, this is something we help with. We actually engage a third party. We'll aggregate all the fund expenses, the fees paid to the various different service providers. We send it to a third party and they'll compare it to other similarly sized plans. And again, that's great documentation and information that you can add to your arsenal, just showing that you've fulfilled your fiduciary duties and responsibilities. I think another best practice in one area you always want to make sure you have a good pulse and you're really keeping on top of is making sure that deposit contributions are being made on time and really as soon as possible. Certainly there's going to be times when there's staff shortages or maybe people are out on vacation or, maybe someone's out sick from COVID. This is certainly throwing new curveballs at us this year, but you want to make sure that you have good plans in place because the best offense really is a good defense. And so before anything happens, you want to make sure you have a plan. If someone's going to be out, you have backup. So if you have a payroll person who's going to, what's the process for payroll? If that person's out, who's the backup? And that there is really a clear outline of policies and procedures. Because this is an area where it can raise a lot of red flags. You want to make sure you have policies in place and that you're reviewing these transmissions, making sure that they're done in a reasonable manner. Now, if you're late, on one or two cycles, it's not a huge deal. You can generally self-correct it as long as you deposit the contribution and you figure out the lost earnings and you do that in a timely manner and you document that process that you did it. In that case, it's not a huge deal. Other thing to be aware of is there's different rules based on plan size. So employers who have fewer than 100 participants, you basically have to make sure that employee contributions and loan repayments are done by the seventh business day after the paycheck from which those amounts were withheld is issued. Now, it's a little bit different with large plans, so 100 or more employees. And really here, consistency is key because the DOL or the IRS, they're going to look at what's been the pattern that you've set. So if you've consistently been depositing it, the third business day, but then you start doing it later and you're making it around the 14th business day or 15th, that could pose more scrutiny because you've established a pattern where you've shown you're able to do it sooner. So just want to be clear on kind of what the rules are around each of those. But again, if there is an issue, it's usually not a big deal as long as you catch it and you remedy it. And there is self-reporting methods. But again, this is such an important area because, again, it could be a red flag, especially if it's an ongoing pattern. It could trigger a plan audit because, when you fill out your annual 5500 form every year, you have to report if there were any late contributions or any late deposits. And so, again, if there's a pattern there, that may raise extra scrutiny. And of course, always as part of all of these different duties, you want to keep good records. You want to make sure you're on top of all of the day-to-day operations. So, of course, you want to make sure your plan documents are in compliance. You're reviewing plan transactions. You're ensuring the plan is in compliance with respect to non-discrimination testing. And if there are any errors, those are documented and corrected. These are all things that you want to make sure that you're doing. And this is something we take a really active role in helping identify what's being done related to the plan and when was it done. So, for example, many of you, you may have seen what we call our fiduciary checklist, where we will track and actually keep dates and records and copies of all of these different things throughout the year, so that, again, you have a robust file of all the different actions that are being taken with regard to fiduciary duties and responsibilities throughout the year. And of course, as I've mentioned, it's document, document, document. If you do something, if you have written procedures and you document that you followed those written procedures, that's what the DOL cares about. It does you absolutely no good if you have procedures, but you don't follow them, or you can't prove that you actually followed them. And of course, you want to have good communication with your participants, making sure you're staying in touch and keeping in the loop with them with regard to the qualified retirement plan. And of course, every year you have your required participant notices that go out, the safe harbor, the QDIA, the summary plan description documents, those go out on an annual basis. But even more still is it's important to have regular education to, one, engage employees, to capture new employees, and to give employees and participants confidence in the plan that's available to them for retirement. Because again, there is this bigger need. It's not just a check the box function that you're trying to fulfill. It's these qualified retirement plans. These play a really important role in a person's future retirement. So we want to make sure that we're providing the right type of communication and the right type of education. So making sure you're having regular enrollment meetings or re-enrollment meetings just to re-familiarize folks with the plan and the features and what's available to them. And then what we do a lot too is provide education on other financial matters, because again, you want kind of robust financial wellness. It gives employees, again, better confidence in making decisions with regard to their future retirement. So it may be, we've been doing education sessions on elections and how that may impact stock returns. So it could be something topical like that. Or back in March when we did some training around volatility in the markets related to coronavirus and what to do or what not to do in those types of scenarios. Or it could be just general financial planning. What are some tips to help you manage student debt, or buying a house, or getting an estate plan in place. And so that's part of a more robust financial wellness or education program that you can put in place. And of course, making sure that your participants know that if they do have questions, that they can actually have access to an investment advisor. They can have a one-on-one meeting if they have questions about the investments in the plan, or how to build, how they should plan for retirement. That's certainly something you probably don't want to be in the middle of or giving advice on. So you have experts that you can connect your participants to. And then lastly, of course, I'll mention again, just as part of all of this, it's always good to make sure that your plan is protected and your plan participants are protected. And again, what we're seeing is a lot of increased cybersecurity threats. And so one of the biggest pieces of advice I can give clients and participants is for all of your, obviously for your network at work and for your employees that may be working remotely, require that multi-factor authentication for your network. And for your providers on the 401k, for a lot of our clients, most of our clients, they have, if a participant wants to log into their email account or to their 401k account, several of the record keepers will have a dual authentication system, or they'll get either emailed or texted a code where they have to log in. So it limits and whittles down some of the fraudsters that may be trying to hack into 401k accounts. So make sure and talk with your providers, the record keeper, for instance, and see how do we get that turned on, or how do we encourage our employees and participants to get that turned on. I'll also, mention, obviously you want to safeguard, use portals as much as possible. We always have a portal set up for all of our clients so that we're not having to send sensitive information. And if we do have to send it, we're certainly using an encrypted email service. But just making sure that this is, you're thinking about this. Many of you may already have a cybersecurity policy in place within your firms and companies, but again, just always make sure you're always putting your fiduciary hat on too and thinking about how that may impact the 401k plan as well. And if you have questions about that, obviously we can certainly help address some of those issues offline and give you tips on how we've set certain things up and different vendors that we've looked at and have used. All right, that brings us to our final polling question. Okay, third question is, I can clearly identify who is providing record-keeping services, third-party administrative services, custodial services, and investment advisory services. Yes, no, or some, but not all. All right, this is good to see. A majority, over 80%, said yes, they could identify who's providing all of those services. And a few people said they could do some, but not all. So that's really good. Okay, all right. Well, that's kind of high level what we wanted to cover. Again, what we thought was most important to address this year, just given all the different things that were going on. You know, we'll leave a little bit of time too if anyone has any questions that they want to submit or ask, while either to me or Julie, we're both on and are happy to chat. Or if not, of course, our email is up here. Our phone number is up here too. So if you're like me, it'll be like a day later where the question that you meant to ask pops up. And so you certainly know where to find us if that's the case. No. All right. Well, thank you all. We certainly miss seeing your faces, but we've enjoyed. I know we've had a lot of Zoom meetings with a number of you, just with regular committee meetings. As you all know, life does go on, so it's at least been great to catch up and see your faces in that regard. But we certainly hope everyone stays safe and stays healthy and well.